Depreciation, chapter 14. There are 5 objectives, learning objectives here, but what we're going to be focusing on is just the first 3. 14.1, straight line method. 14.2, declining balance method. And 14.3, sum of the years, digit method. So let's go on to 14.1. Generally speaking, we're talking about how a business may purchase items that we consider to be what is referred to as an asset. And an asset is something that has future value. Now, when you buy something that has future value, let's say like a piece of equipment, buildings, trucks, machines, improvements to buildings, those items are not considered to be expenses immediately. For tax purposes, you can't write those off immediately. What you have to do is first consider them to be assets, and then over their useful life, you can then write off or expense those costs over a specified period of time. Now, this process of writing off or taking the cost and allocating it as an expense is called depreciation. In my accounting classes, I refer to depreciation being the systematic allocation of cost over the useful life of an asset. So we take that cost, that original cost of the asset, and systematically expense that cost over its useful life. Now, when you do this, there are various ways we can do this that are acceptable by what is referred to as generally accepted accounting principles, but that's more of a financial accounting concept. So what we're just going to be looking at is the methods that are acceptable and disregard the fact that why it's acceptable. But the four elements we're going to look at is, well, I think we're going to look at just 3 of them, but there are 4 here listed here. There's straight line, which is the first thing we're going to cover. Declining balance, which is the second one. We're going to cover some of the year's digits. And there is a units of production, but I don't think we're going to cover that. That's not part of the first 3 objectives. So, okay, so straight line. Some key terms we need to really understand. Physical assets of a company, such as machinery, trucks, cars, and computers, are tangible assets. Tangible meaning they have substance. You can touch them, feel them, pick them up, maybe even drive them if they're a vehicle. There are some assets that are considered intangible assets. They don't have any physical substance to them. Those assets are considered to be patents, copyrights, franchise fees, a customer list. All companies can buy these as well. So when we purchase those as a business, we consider those to be intangible assets. So tangible is something of substance, and intangible is something that has no substance to it. But it's still a cost, something that you purchased that will provide future value. Let's take a look at the key terms here. Cost is the basis for determining depreciation. It's what you paid for an asset. It is the total amount paid for the asset. Oh my goodness. Useful life is the period during which this asset will be used. The focus here is often going to talk about tax purposes. The Internal Revenue Service has guidelines for estimating the life of an asset. So you can use the Internal Revenue Service guidelines for tax purposes. Just a heads up, you can't use those for financial accounting purposes, but that's another class altogether. A salvage value or scrap value, sometimes it's referred to as a residual value, is the estimated value of an asset when it's retired from service. So the easiest way to describe it is that if you purchase a vehicle today, let's say you pay $20,000 for it, and you plan on using it for 5 years, you have to estimate in 5 years what is the value of that vehicle. What's going to be the value of that vehicle? And that value we refer to as a salvage value. It is an estimate, by the way, especially when we first identify it. But the salvage value or residual value is an estimate, and then when we actually sell it, that's when we know exactly what its value is. Accumulated depreciation, that is the amount of depreciation taken so far, a running balance of depreciation to date. So every year you're going to go ahead and recognize some depreciation. Every year it's going to be a total amount that's being depreciated. Accumulated depreciation is keeping track. It's adding up all those years. If you have an asset that's going to last you 5 years, well, you track it for 5 years, and after the second year, you can see, well, how much so far. After the third year, how much so far, and keep an accumulation depreciation of that asset. And then the book value is the cost of the asset, the cost, what did you pay for it, like a vehicle as an example, minus the accumulated depreciation. Let's say you're in year 3, the cost of the asset was $10,000. You've already accumulated over the 3 years, let's say $6,000. So a book value is the cost minus the total depreciation to date, or accumulated depreciation. So if we figure 10,000 is the cost, if 6,000 has already been depreciated over the 3 years, then the book value is going to be $4,000. It's just the cost minus the accumulated depreciation. Now, the straight line method is the most common method used by companies because it's the easiest, and most people can't argue whether it's right or wrong because it just makes, in often cases, it makes the most sense. So the way we figure out every year, we have to turn around and figure out, well, how much are we going to depreciate it? Well, if it's straight line, then every year is going to be the same amount every year, and we're going to take the cost. We're going to take the cost. We're going to subtract what we call the salvage value, the cost minus the salvage value. Remember, this is an estimate. We make this determination when we buy the asset itself. We estimate what we're going to sell it for when we're done with it. And that's going to be the amount to be depreciated. Often we refer to that as the depreciable cost. So the cost minus the salvage value gives us the amount to be depreciated. And then we take that amount and we simply divide it up evenly for the number of years we're going to be using it. So let's say, as an example here, we have a $14,100 cost of a trailer. Looks like it has a useful life of 8 years, but we also have a salvage value, an estimated salvage value of $2,100. So to compute the amount to be depreciated, we're going to take $14,100, the cost, minus the salvage value. Well, we determined that the salvage value is $2,100. And we're going to get $12,000. That is the amount to be depreciated. Now, once we have the amount to be depreciated, then we just simply take that amount and divide it by its useful life. In this case, it's 8 years. So we'll take that $12,000, the depreciable amount, and we'll divide that by the years of life, which in this case is 8. 12,000 divided by 8 gives us $1,500. So every year we are going to depreciate this trailer $1,500. So going back to how we compute the amount to be depreciated, we'll take the cost. In this case, it's $14,100. That's listed here. And subtract from that the salvage value, which is $2,100. Therefore, the amount to be depreciated is $14,100 minus $2,100, which is $12,000. So now that we've computed the amount to be depreciated as $12,000, we can then compute the annual depreciation. The textbook just refers to it as depreciation, but really it's the annual depreciation. They changed the words on you because they call it depreciable amount here, and then they had called it before amount to be depreciated. That really is the same thing. All right, so let's go ahead and go through this process. Depreciable amount is $12,000. We computed that in the previous example. We're going to divide that by the years of life. Let's see, what are the years of life here? Years of life, it's useful life of 8 years. So I'm not quite sure why they just don't call it useful life too, but years of life and useful life appear to be the same. So now when we look at the annual depreciable amount, we'll take 12,000 and we'll divide that by 8, and that's going to give us 1,500. So every year we're going to depreciate this trailer $1,500. After 8 years, we will have depreciated it $12,000. Now, if we're going to keep track of this every year, let's say it's year 1, We're going to call that depreciation expense. So for this trailer, we can see that every year we're going to depreciate it $1,500. All right, so for 8 years in a row, we're going to depreciate it. Now, each year, we're going to figure out, well, what is the accumulated depreciation? Well, the first year will be, it's the first year, it's only been done once. So it's $1,500. The second year, we're going to take the second year depreciation and add it to the previous year, which was $1,500. So after year 2, the accumulated depreciation is $3,000. After year 3, your accumulated depreciation is $4,500, and you can see we're just adding $1,500 every year, all the way till the very end, and when we get to the 8th year, the accumulated depreciation will be $12,000. That's what we're trying to depreciate. We then go to what's referred to as the book value. The book value is computed by taking the costs minus the accumulated depreciation. So we can actually add here the book value. So we know what the annual depreciation is. It's $1,500. And we can plot out every year how much we're going to depreciate. Well, there's year 1, 2, 3, there's 8 years. And each year we're going to depreciate it $1,500. So the depreciation expense every year is $1,500. Now the accumulated depreciation is taking the accumulated amount that has been depreciated. After year 1, we've only had 1 year, so that's $1,500. After year 2, 15 plus the 15 that has already been done is $3,000. And every year the accumulated depreciation increases by 15, so that by year 8, our total accumulated depreciation is $12,000. We're just adding $1,500 every year. So the accumulated depreciation shows year to date, or up to date, how much has been depreciated. Now the book value can be computed by taking the original cost minus accumulated depreciation. So for year 1, if somebody asks, well, what's the accumulated depreciation for year 1, how much is the book value? Well, we can compute that by simply taking the original cost, $14,100, and subtracting the accumulated depreciation. So after year 1, the book value is $12,600. The cost minus the accumulated depreciation. For year 2, we're going to take the cost minus the accumulated depreciation for year 2, which is $3,000. This minus this. So that's going to give us $11,100. So the book value after year 2 is $11,100. One more, year 3 would be $9,600. The way we do that is we take the cost, $14,100, minus the accumulated depreciation. This minus that gives us the book value, $9,600. Now pretend I just did the same thing for the next few years until we get to year 8. In year 8, the book value is going to be $2,100. Well, if you think about it, that's exactly what we wanted, because when we started working on this problem, we wanted our salvage value to be $2,100. That's our salvage value. So at the end of its useful life, the book value will be equal to the salvage value. So you can take any one of these years and decide, okay, if I asked you, well, in year 4, what is the book value? There it is, $8,100. Cost minus the accumulated depreciation. A fast food restaurant purchased a new low-fat chicken cooker at a cost of $26,500. The estimated life of the fryer is 5 years with a salvage value of $3,500. Find A, the annual rate of depreciation, B, the amount of depreciation, and C, the amount or the book value at the end of first year. So the first thing it's asking is, what is the annual rate? Now, what may not have been very clear when we did it for the previous example. In fact, let's go back to the previous example, which was the cost of $14,100. So our first question is the annual depreciation rate. And the question is how do we come up with that? Well, let's go back to our previous problem just to kind of shed some light. When we did the annual depreciation, we said that this amount, the depreciable amount, is going to be divided by the number of years, or years of useful life. So what that means, in the previous example, it was 8. Okay, so 8 years. That means every year, 1/8 of the cost would be depreciated. 1 of 8. Every year, 8 years, 1/8 will be depreciated every year. Well, the same logic holds for 5 years, except now instead of 8, it's 5. So for 5 years, every year the amount to be depreciated is 1/5. 1/5. And if you think about it, 1/5 as a percentage, 1 divided by 5 is 0.2 or 20%. So the rate for 5 years would be 20% per year. If you think about it, for 4 years, it would be 25%. For 3 years, it would be 33.3%, etc. So that's the solution to the first question. What is the annual rate of depreciation? It's 20%, which the way we get this is a 5-year life would equal 1/5 per year, or 20%. The second question asks the amount of depreciation. Well, they want us to then compute the depreciation based upon a new formula, a different formula. Well, first of all, let's go back. The annual depreciation, the way we learned before, is we'll take the depreciable amount divided by the useful life. Well, we had to come up with the depreciable amount. So the depreciable amount is computed by taking the cost, $26,500, subtracting the salvage value. That is, here's the formula, and here are the numbers plugged in for that. So the depreciable amount is $23,000, $26,500 minus $3,500. That's the depreciable amount. Now that we have the depreciable amount, we can then compute the annual depreciation, which in our previous example is computed by taking the depreciable amount, dividing it by the years of life. In this case, it's 23,000 divided by 5, because its useful life is 5 years, which gives us an annual depreciation of $4,600. So what do we need the rate for? Well, there is another way we could figure out the annual depreciation. The way we do that is simply take the depreciable amount, multiply it by the depreciation rate. So we'll figure out what the annual depreciation is by taking the depreciable amount of $23,000, that hasn't changed. But now we're just simply going to multiply it by 20%. 23,000 multiplied by 20% gives us $4,600. So the annual depreciation is $4,600. $4,600. And then the last thing they wanted us is what's the book value at the end of the first year? Well, the book value is computed by taking the cost, $26,500, and subtracting the accumulated depreciation. Now they wanted it after year 1, so that makes it easy. It's $26,500 minus the accumulated depreciation of $4,600. That gives us $21,900. And we can continue to do that every year. The book value after year 2 is $17,100, or $17,300. The way we get that is we take the cost minus the accumulated depreciation as of year 2, and that is $17,300. We keep going down every year until the 5th year. We end up with the book value of $3,500, and that is equal to the salvage value. And that concludes learning objective 1.